All right, 2 minutes to the closing bell. Helping us get there, Kristina Hooper, Invesco Chief Global Market Strategist, and Scott Wren, Wells Fargo Investment Institute Senior Global Equity Strategist. Scott, let me start with you because we talk a lot about interest rates. And I'm just curious, does it really matter if interest rates were to tick up, 25 basis points, or even 0.5%? It would mean the economy is doing pretty well, wouldn't it?
I think in reality, Adam, you're exactly right. And, early in a cycle, higher interest rates are a reflection of good things happening. Now, we've had the 10-year yield pop a little bit today after this morning's CPI number. And really, our year-end target is 2.25. So it seems like a long way from here to there. I think the direction is right. We certainly think interest rates should be higher. And even at 2.25, in our opinion, that shouldn't do anything to derail the expansion that we have going on.
All right, we've got about 50 seconds to the closing bell. So let's take a real quick look at where we stand in the markets right now as we head to that big moment. We're going to be down today. The Dow's going to be off about 100 points. S&P 500 will fall about 15, 16 points. Nasdaq's going to be off as well. But some of the Dow components want to pay attention once again to Boeing. It is the biggest loser today on the Dow. It's going to be off about 4.5%. And there was the news we got yesterday about the delay regarding the 787 Dreamliner deliveries. But also one of the losers today in the Dow is JP Morgan Chase. After their earnings today, the revenue fell short of what Wall Street had been hoping in regards to the bank's earnings report, despite them having a good report. So they're off today by about almost 1.5%. Some of the sector action that we're paying attention to, the only sector in the green right now is information technology.
And that'll do it for the trading day, this Tuesday, July 13th. Do you want to take one last quick look here to see where we're settling on the end of the trading day? We do have the Dow down about 100 points, a little over 100 points. And as Adam was mentioning, we do have Boeing and Caterpillar, the biggest losers. But on the flip side, some of the outperformers coming in at Visa, Microsoft, and Apple. So again, a bit of some tech and growth outperformance here on this trading day. And that's even as we are seeing Treasury yields moving higher on the long end of the curve, that 10-year Treasury moving higher by almost 5 basis points. Now, Kristina, I want to turn it back over to the panel. One of the things that you mentioned in a note ahead of your appearance today is that the 10-year yield is a better fear gauge even than the VIX, which of course actually has the title of fear gauge for investors. What do you think the 10-year yield is telling investors right now at these levels?
Well, certainly the 10-year yield has reacted positively to the CPI data. There is certainly an expectation that the Fed is going to raise rates. And I think that markets do get worried sometimes that any kind of premature increase in rates could somehow slow the economic recovery in some kind of big way. But the reality is that the Fed adopted a different policy last year, and I think it is something of a paradigm shift. Flexible average inflation targeting means that the Fed isn't going to take the punch bowl away just as the party's getting started. It means it's going to leave it out, even if a few participants, partygoers, get tipsy. So it's a very different approach. And so I think, as my colleague mentioned, when rates go up, especially early in the cycle, that's a positive sign.
Scott, what are your preferences for your clients if we are going to have interest rates going up, but if it really doesn't signal the end of the world as we know it? We hear a lot of doom and gloom, which seems inappropriate.
The world is not coming to an end, Adam. But saying that, we like these cyclical plays. I mean, we want to lean into this recovery. We've been doing it for quite a while. Things like energy, materials, financials, industrials. We backed off of technology. We backed off of consumer discretionary. We had been overweight those sectors for a long time. A couple of months ago, we backed off them. We just thought the valuations were high. We're still even weight there because, we think the market is going to be up, let's say, by year-end 2022, let's say 14%, 15% maybe from here. If we get to that 4,900 number in the S&P 500 over the next 18 months, technology has to participate. It just has to. 26% of the market cap of the S&P 500. So once again, those interest rates going up early in the cycle, it's a good sign. Inflation going up. It was up obviously higher than what a lot of people expected today, but we expect it to decelerate next year. So we're not looking for a long-term inflation problem. We're not looking for the Fed to come in and have to slam on the brakes. We think it's going to take them a long time to taper, and we want to be, leaning into a continued rally here in U.S. stocks.
And Kristina, of course, with second quarter earnings underway, just taking a look at the big reporters today, JP Morgan Chase, Goldman Sachs, both closing lower despite posting pretty strong results on the top and bottom lines. A little bit of weakness when it comes to some of those trading revenues and some other business areas. But does this signal, this stock reaction we've been seeing to these beats, signal that maybe expectations have gotten a little ahead of themselves?
No, I think this is a very normal part of earnings season, right? When expectations are high and they're met, then typically we do see a bit of a pullback in stocks. So this is nothing out of the ordinary. And I do believe that this is going to continue to be a very strong earnings season. And I believe sentiment in the market will remain positive. I think the question becomes, how long do we remain overweight cyclicals? How long do we want to favor value over growth? Because I think at some point during this back half of the year, we're likely to see the market start to favor growth, at least in small increments, just as the market starts to discount a bit of a slowdown, still strong growth, but a bit of a slowdown in early 2022.
Let's pause for a second. Jared Blickery is watching markets, especially now that we've jumped into earnings season with the banks reporting this morning. Jared?
Yes. Well, I was just looking at Chinese stocks on the Wi-Fi Interactive. One of the few bright spots today, besides tech and staples, which we were talking about earlier, I just read a tweet saying that Cathie Wood is calling for a valuation reset of a lot of these names. So I'm thinking this might be a tradable bounce here. You look at what these stocks have done year to date, and it is a sea of red. I don't know if this is going to come up here on the Wi-Fi Interactive, but could be something of a technical bottom here. Just throwing that out there.
All right, well, we want to turn it back to the panel. And Scott, I want to ask you, given where we are right now in the recovery, where are you still seeing opportunities? We've been hearing some strategists talking about looking outside of U.S. equities. Do you see any opportunities there?
Well, I mentioned those domestic sectors, and as far as internationally, we do like the emerging markets, and China has stumbled. Certainly, if you look at the MSCI China index, it's down. It's basically on some technical support here, and so really, China, South Korea, Taiwan, we expect good things there as we look down the road. So besides large cap U.S. and small cap U.S., we also like emerging markets. So those are the three really asset classes that we're leaning into. Developed international, Japan, the Eurozone, that doesn't look all that great to us at this point, but emerging markets does.
Kristina, I'm curious what your thoughts are when we look at Europe, because we've had other guests tell us that we have been unappreciative or undervalued European stocks, but there's still some hurdles that the European economies have to grapple with regarding COVID.
Absolutely. But what we do see is the Eurozone following in the direction of the United States. It may be a few footsteps behind, but it does seem to be following in the direction of the U.S. And so one could certainly make a very strong case for European equities, not just for valuation reasons, but because it is likely to experience significant economic growth in the next few quarters. And we could see cyclicals and value, which comprise a larger part of the European stock market, perform well in this kind of environment.
Well, we want to turn it back to Yahoo Finance's Jared Blickery on the floor of the New York Stock Exchange. And Jared, you have a take on the Nasdaq?
That's right. I wanted to pull up something on the Wi-Fi Interactive here. We have a reading of breadth. Now, this is the Nasdaq Advanced Decline line in purple that we're seeing here. And as the Nasdaq was making record highs, it was confirming it. And then it started falling off, and it came into a downtrend. Recently, this is beginning with May, it once again started leading, but now it is on the decline once again. We have a series of lower highs and lower lows, while the Nasdaq is making higher highs, record highs. That means that there aren't that many stocks participating in this rally, and it just creates the possibility of some large downdrafts, as we've seen several other times this year.